But the euro area, right? So before the election, everyone was pretty much, I say everyone, but all the bank analysts were pretty much talking about how the Donald Trump win was positive or appreciative of the dollar, and the euro is was likely to sell off, and it does look like that is the case, and that is happening. And so there was an article that I posted in the US election channel, but this is basically a bit of a synopsis of it, some of the best bits from that article, and it was actually a really good article in terms of the breakdown of not only the euro dollar but pretty much, you know, bonds. And maybe I might just go into that anyway. I might just go into it rather than maybe reading it off the euro. One second. It was this article here, right? So, yeah, we're talking about obviously the euro and the dollar, but I'll read the article because I do think it's a good article, and it's good to kind of get I guess, a macro view on what the market is really thinking. So it says here, Donald Trump quickly put his stamp on the financial markets as his victory in the US presidential election propelled Trump trade plays across assets. And that was, you know, for anyone who's new, that was what was happening with the US dollar, right? So over since the beginning really of October, there was the Trump trade idea. So, you know, this is buy the rumor. For anyone who doesn't understand what buy the rumor, sell the fact is, this is probably a perfect example of buy the rumor, sell the fact, right? So fundamentals were kind of kicking in. Of course, you know, the dollar was expected to cut by 50 basis points, right? But then we had some decent data out um, that was basically suggesting that rather than the Federal Reserve cutting by 50 basis points, they were likely to maybe cut by 25 basis points. But at the same time, we also had information in the mix that Donald Trump, you know, could be the potential winner of the election. And really, the market was putting their money where their mouth was, right? Regardless of what was happening on, you know, with media, social media, and the mainstream media. You know, the prices for the dollar was really kind of appreciating at the beginning of October. And so, yeah, this is basically what you would call the buy the rumor. Right now, the rumor doesn't always uh, work out. Of course, doesn't always plan out, but it doesn't have to, right? Because the money really is made, yeah, by the rumor. Yeah, the market prices in what they think the value of an asset or a currency is going to be before the fact. Yeah, this is before Donald Trump actually won. So by the rumor, and whether Donald Trump became president or not, right, at this point in time, if it sold off, the guys who bought anywhere around here and was buying the dollar would have still made money regardless, right? It doesn't matter. So this is what fundamentals essentially, and understanding fundamentals essentially is trying to buy ahead of time. Yeah, is trying to understand what gives an asset its value, right? And deciding whether something is undervalued or not based on the probability of a future event or, you know, future data coming in, right? So ultimately, the rumor was made that, you know, from way back in July, that the Fed were looking to cut a lot more aggressively. Did they actually cut a lot more aggressively? No, they didn't. But it didn't stop anyone from shorting the dollar and making money, right? Donald Trump obviously did win, right? When the rumors started that he could possibly get to the presidency, but it didn't matter whether he did or he didn't. Yeah, because everyone would have, the smart money would have made their money way before everyone else did. So this is a classic example. If you remember anything, right? If you remember anything, there's lots of things to remember, obviously, in fundamentals. But if you remember anything about you know, buy the rumor, sell the facts, and you want an example of it, yeah, this is it. This is like the perfect example, both from a fundamental perspective, right? From interest rate cuts, from a risk sentiment perspective, the election results, yeah. as to why buying the rumor, selling the fact is really what we do, and how to kind of get ahead of the curve, right? So, many of us, and also as it was, it's important to understand that you're not always going to catch the bottom of the rumor as well, right? You're never going to catch the bottom of the rumor, right? We didn't, yeah. But when it started to look like Donald Trump might start to win, that's when the bias, many of us, in the group were like, okay, the last, few weeks, we were like, okay, do you know what? A Donald Trump win is going to be positive for the dollar. And then we were waiting for kind of like pullbacks. The pullbacks didn't necessarily happen, couldn't get into the dollar, unfortunately, on that run. But ultimately, we got the direction right. And if anyone's strategy, if you're a breakout trader, of course, then you would have been happy, right? Because you would have been buying at highs and it would have went higher. That's a strategy that personally, I don't necessarily trade. But ultimately, if you're looking for a pullback, and it's about getting the direction right. And so really I take okay, solace, I guess, in the fact that, you know what, I get the direction right. Did I make, money buying the dollar? On this occasion, no, but there's always going to be opportunities to buy the dollar. The dollar will pull back, and when it does, if it pulls back to there, that zone there, right? Because ultimately, we've now created some demand zones. Right? We've got some demand zones now, right, where we know that if prices pull back on the dollar index, equally weighted dollar index, we know that that is a bargain, right? Price. Because we know that it's a potential bargain price, right? Because basically traders bought here, that's not subjective, that's totally objective. As if prices come down here, as long as the fundamentals remain the same, then that is seen as a bargain price. So we know which direction now we should be trading in when it comes to the dollar. But getting back to really the euro, starting off on the euro, is that this is a great illustration. Oh, sorry, no, it wasn't that I was meant to read. It wasn't that. It was this, really the kind of the macros. So basically, Donald Trump, and we're talking about the Trump trade played out across the assets and how it's going to play out, right? So the swings send a clear signal that investors believe a second Trump administration will look a lot like the first one. A stream of policies, tax cuts, deregulation, tariffs that will simultaneously stoke economic growth. Yeah. So stoke economic growth, meaning it's good for the economy, right? Corporate profits and inflation, right? So, do you guys remember? Do you guys also remember? And you maybe, if you're new here, you may not have seen the video, but I produced a video. It's on YouTube, but it's also in the discussion room videos. If you look for it, it's about cycles, right? And it's really something to remember and a bit of a template, yeah, to understand the relationship between, let's say, for example, this is interest rates, right? This is inflation, and this is GDP, right? Now, typically, usually, they all follow each other, right? When you have a hike in interest rates, normally inflation is going to the upside and GDP is growing. Yeah. If you have interest rates are falling, or let's say, for example, inflation is falling below the 2% target, or GDP is contracting, normally the effect of that is um, for interest rates to be cut. Of course, they can be held as well, hike holds and cuts. But if you're looking at, inflation coming down below that 2% target, or GDP heading into maybe some sort of, contraction, recession phase, bust or slump phase of the economic cycle, then it's sure to follow that interest rates have to be cut, right? And that's basically what we see here in this article, right? Is that they're saying that everything should move in alignment, right? So that will simultaneously stoke economic growth, right? Economic growth, right? So we're on this end of the cycle. So if you start to see economic growth, what should you also see? Inflation start to rise. Yeah. Are there times where that doesn't happen, where you have growing inflation and inflation? I mean, growing, economic growth. The recovery expansion phase of the economic cycle, but inflation doesn't necessarily go to the upside. Of course, there's going to be periods here and there, but ultimately, if you zoom out and look at what typically happens historically, this is basically what should happen, right? This cycle should play out. Yeah. And so that's basically it, right? So economic growth and inflation, which then leads to what? Right? What does that lead to? A potential rise, or at least a hold or a reduction in interest rate hikes, right? Or I say a reduction in interest rate cuts. So if we're on a cutting cycle and you've got inflation going higher, then you really can't. The central bank is likely to not cut rates as much as expected. This is why the dollar is moving and appreciating as we see, right? So for the Wall Streets, for those on Wall Street who've been riding the Trump trade, and especially those who held their nerve as it wobbled on the eve of the polling, this was a moment of vindication. If you had the Trump trade on the last 6 weeks, it's been outstanding, said Ed Al Husseini, a rate strategist at Columbia Threadneedle Investment. The question is, these winning runs don't last forever, and is this a good time to take profits? Right. The surge in Treasury yields underscores concerns that Trump policies will swell an already bloated budget deficit and reignite an inflation spiral that Federal Reserve was only just finally quelling in the wake of the pandemic. Now, for people that are not familiar with how treasury bond yields work, simply put, right? And there is, by the way, for those of you who are new, there's a bond channel, bond education channel. So if you go to 20 government bond education, and that will, if you go through those videos and the posts in there, that will pretty much break things down. But just again, from a very simple perspective, right? Bond yields are sensitive to interest rates. Bond yields are basically government debt. Yeah. Now, in order for and the government, every government sells debt, right? Packages debt, and there are investors that buy debt. Now, to make government debt, like who would want to buy government debt, right? Nobody, pretty much. So, what you have to do is, or what governments do, is they provide a yield for you holding government debt, right? In the form of government yields, right? Now you can buy different dated yields, whether it's 3 month, 6 month, 1 year, 2 year, 5 year, 10 year debts, right? And hold them, right? And yields. Now the two main uh yield government bonds are really the 2 year. Don't know why I put 2%. Sorry, 2 year and the 10 year. Right, is what traders typically watch for kind of short term and long term expectations for yields. Now, why are yields important? Simply put, the yield government yields should usually be higher, typically be higher than interest rates. Right, so you have interest rates and then you have government yields. Now, in order to entice traders to buy treasury bonds, yeah, rather than invest in, for example, just the currency and get the interest rate, yields have to be higher, because otherwise, if the yields aren't higher than interest rates, then it makes no sense to buy yields, to buy government debt. I'd rather just buy the currency, hold it in a bank, and then get, let's say, for example, 5%. Yeah. If yields are 4%, yeah, 2 year yields of 4%, or 10 year yields of 4%, what's the point? No point, right? So typically, the longer the yield that you have to hold for, right, the higher the the longer you have to hold the treasury bond, the higher the yield, right? Because you're committing to 10 year, 2 year, right? So that should be year, yeah, and the lower the interest rate. But regardless of whether you're holding 2 year or 10 year, right, yields should normally be higher than the interest rate. So whenever yields start to go higher, right, 2 year, 10 year starts to go higher, guess what? What that's signaling is that they think that interest rates should also go higher. Does that make sense, everyone? Does that make sense? Yep. Tom says, everyone else all right? Everyone else follow? The bond traders, right, are thinking to themselves, well, if interest rates, yeah, exactly. If interest rates are going up today, yeah, then yields have to be higher in the future. Because otherwise they're going to come out of yields and just go into go into the interest rates and take the money out of government debt. So they have to be higher, right? So when you're reading something like this, where it says, um, where was it? Where was it now? Where was we? Um, the surge in treasury yields underscores concerns that Trump policies will swell an already bloated budget deficit and reignite inflation, the inflation spiral that the Federal Reserve was only just finally quelling in the wake of the pandemic. Yeah. The 30-year yield climbed as much as 23 basis points to 4.6 to 4.67, its biggest daily jump since 2020. So they're looking at the 30-year yield going higher because they think that interest rates are going to be higher in the short term. Therefore, you have to have a higher yield in the long term, right? And it says the 10-year rate, break even rate, a market gauge of where long term inflation is heading, surged to its highest level since April. In the parlance of Wall Street, this is the bond vigilantes exerting pressure on leaders in Washington to keep spending in check. So bond yields going higher means that they think that interest rates are going higher. And it says here, a key outstanding question for markets is whether Republicans end up with a trifecta, meaning a situation where they gain control of the Senate, the House, and the White House. Beyond that, it remains to be seen whether Trump will actually deliver his campaign trail promises. And here, with October record high for the S&P now in sight, sectors viewed by analysts as likely to benefit under Trump advance: fossil fuel energy companies, banks, pharmaceutical providers, prison managers, and smaller capitalization companies all rose in early morning trading. So, if you are an investor in certain sectors, then those are likely to continue rising during Trump's administration. Of course, we have to wait on the policies and who gets the House. Those seen as struggling under Trump administration include renewable energy stocks declines. The biggest winners will be sectors and industries welcoming a more business-friendly regulatory environment, said Stephen Dover, chief market strategist and head of the Franklin Templeton Institute. At some point, however, rising bond yields may cap equity market gains. Why would um, rising bond yields cap equity market gains? The reason why is because bonds and stocks typically actually move in the inverse. Reason why is because if you've got money on the sideline, if let's say for example you've got, I don't know, £1 million, right, $1 million, um if you got a risk on environment, right, where you think the stock market is going to make maybe something like maybe 10%, 11% a year, let's say, for example, the average, why would you then put your money into bonds, which may be only offering you something like 4%? Doesn't make any sense, right? You'd be like, well, I can just get 10% in the market. So I'm going to put more of my money, right? Of course, you want to hedge, nothing's, guaranteed, but you want to put maybe 80% in stocks and maybe 20% in bonds, or maybe do the 60-40 model, right? 60 in stocks, 40 in bonds. So but typically, and it's wrong of me to say inverse, right? It's not necessarily inverse. They don't necessarily move inverse, but you have more money going into stocks than you would going into bond yields. But if you have rising bond yields, right, then that's more attractive because ultimately it's easier to hold the bond yield for doing nothing, right, and getting guaranteed yield every year, or however long you hold it, then actually investing in the stock market, because stock markets are a bit more volatile. They go up and down, right? So even though yes, you could necessarily make, you could make 10% this year, doesn't mean it's a guaranteed. Whereas bonds pretty much, um, uh, are a guarantee that you will get that for the next however many years, depending on when you buy. But bonds are seen as more of a safer bet, right? It might be a lower yield than stocks, but at the end of the day, some people are risk averse, right? So they'd rather maybe 5%, yeah, guaranteed by buying bond yields and not having to deal with the volatility of the stock market rather than, investing maybe and trying to get 10% returns, 20% returns in the stock market, but trying to time the stock market, right? So rising bonds are attractive and may cap equity gains because money may come out of the stock market and equity markets and go into the bond markets, right? Uh, Alexandra says that's why our pension funds are in bonds. Absolutely, because they don't like the volatility. They do not like the volatility at all. Sorry, Tom says, does the same apply when invested? E.g., interest rates start to come down. We expect bond yields to follow because yes, that's exactly it. That's exactly it, Tom. 100%. So when bond yields start to come down, that's the expectation of interest rates coming down. That's exactly it. You can see it on the chart, by the way. So if you go to bond yields, go to US bonds, US yields. Let's go to this is the 1 second. This is the sorry, inflation. What am I talking about? Um, sorry, bond yields are right here. Let's go to 2 year, right? So remember, we had July, August, September. Remember, we were having that situation where we were having 50 basis point cuts, right? Earlier in the year, July, August, September. Look what was happening to the 2 year yields, going from 4.5 to 4 to 3. And then when we had the Trump trade, interest rates potentially, staying where they are, or maybe even going higher. I don't know whether they go higher because the Fed is still expected to cut, but ultimately they're not looking to cut as aggressively, right? So ultimately, we're seeing bond yields go higher. Yeah. So that's basically uh the play. That's why it is important to also watch bond yields for I guess, to look at the kind of like the medium to long term plays on, and even short term plays on, and confirmation, I guess, on interest rates. Right. So when you start to see massive drop in yields, and sometimes you might get yields move before the currency. Sometimes you, sometimes you don't. But if you start to see a situation where bond yields are maybe just dropping like a stone, but yet the currency hasn't, then actually you should be on alert for the currency to drop as well, or the expectation that the central bank may come out and announce maybe there might be a bit more dovish or announce rate cuts because the bond market is actually the canary in the coal mine when it comes to interest rates. Yeah. So with that being said, let's continue on. So, what Bloomberg strategist says at this point, and welcome, by the way, Alexandros. Welcome. And everyone else who's joined, Jeff, Paul, Chris, and a few others, I think. It says here, at this point, the House race is the most important thing to watch because a Democratic win there will obviously not while obviously not the base case, is still possible. That in turn would likely scuttle much of Trump's agenda, at least the bits that require legislative approval, e.g., taxes but not tariffs. A common view is that a red sweep would be worth about 25 basis points on the 10-year yield, and we're obviously a good way towards discounting that already. In currency markets, right? The dollar reached its strongest in a year before pairing the move. While Trump has advocated for a weaker exchange rate, investors reckon his policies will fan inflation and slow the pace of the Fed's interest rate cuts, thereby boosting the greenback. So pretty much, that's just confirmed everything that we've been talking about. The tariffs he hailed would also likely hurt foreign economies more than the US. Um, no worries, Alexandros. The dollar's surge put commodities under pressure, right? So here's another effect of a stronger dollar, an appreciating dollar. So it says here, commodities under pressure with oil, copper, and gold all falling. Although I kind of have maybe a bit of a different, I don't know, gold, I think might have reached this peak, but I'm still a buyer of gold on pullbacks. And when I say pullbacks, I'm not talking about some hourly chart pullback, by the way. I'm talking about like a deeper pullback. Because it does depend on how inflationary Donald Trump's policies are seen to be, right? So let's see. Soybeans slid the most in a month, blah, 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 right? And it says China, trade tensions with China are the biggest buyer. One of the largest gainers was Bitcoin, which rose more than 8%. So, all of you who are into crypto, which I am, hopefully your portfolios should be looking decent and adding to a surge in recent weeks as Trump embraced digital assets. So, that's a bit of a side note. Trump was seen as definitely being positive for crypto. I did post something a while ago, matter of fact, when it comes to crypto. I think it was in the crypto channel. But yeah, not to get sidetracked. Markets must now decide if the post-election moves can extend. In doing so, they must extrapolate how much of Wednesday's moves is down to declining short-term uncertainty with the election result now resolved. So that's the macro, right? That's the macro side of things. Going back to the euro, currency traders are turning against the euro as Donald Trump victory in the US presidential race boosted the chance of an aggressive European interest rate cuts, driving the commodity currency towards parity. So, again, this is where the rumor starts, right? So, now the rumor starts. Could there be parity? Could there not be? Now, this is where the money is made, yeah? Or the opportunity. Differing trajectories on interest rates. And this is what we do. We look at the differentials between interest rates in Europe and the US are forcing strategists to reconsider their predictions. While Trump's policies are seen as fueling inflation and curbing the Federal Reserve's ability to cut rates, his promise of global trade tariffs would crank up the pain for Europe's spluttering economy, requiring deeper easing by the European Central Bank. Again, going back to the what we were talking about, right? Go 1 second. Yeah, we look at this cycle. Yeah, if the economy, yeah, is contracting due to whatever reason, guess what should happen with interest rates? Should come down even more, right? There we are. So, um, yeah, so I'll say, where are we now? So the Federal Reserve's ability to cut rates, his promise of global trade tariffs would crank up pain for Europe's sputtering economy, requiring steeper easing by the European Central Bank. With the Fed raising interest rates or keeping interest rates high to fight inflation, just as the ECB continues to lower interest rates, likely at an accelerated pace, the widening interest rate differentials is likely to weigh on the euro, possibly hitting parity, says Georgette Boeli, a strategist at ABM AMRO, who's correctly predicted the euro and dollar hitting the level in 2022. Money markets are betting on 1 percentage point of Fed cuts and around 1.3 percentage points of ECB reductions by September next year. So there's more cuts coming from the euro and the European Central Bank than there is the Fed. Yeah, that marks a widening since Tuesday when pricing pointed to 1.1 percentage points and the 1.16 percentage points respectively. So yeah, it looks like the differential between cutting, right? So the European Central Bank is seen as cutting deeper and more than the dollar. Therefore, we're seeing the euro dollar and really the market get ahead of that when it comes to the euro dollar, right? And let's go to the euro dollar, and this is what we're seeing. So really, I know I'm getting ahead of myself a little bit. Really, the path of least resistance, any pullbacks should be really looked at as short opportunities. Um, Alexandra says big divergence in the overnight Fed versus the ECB overnight fund borrowing. Yep. So that just confirms pretty much what we're talking about, right? So yeah, that's just confirmation data for anyone who looks at that overnight Fed, the ESTR overnight Fed borrowing. So basically, what Alexandros is referring to. Sorry, let me just go to CME. Um, CME FedWatch tool, and he's talking about this. So SOFR. I'm not going to go into it too much, but he's talking about this data here and the ESTR watch, which you can uh, uh, basically look at if you understand it. I'm not necessarily the best to kind of ask about this. It's Alexandros, and he'll be able to explain this at some point if you're very, very interested. That's his that, and this is that's Alexandros' tool, as he says. He looks at this. I don't really look at this, and it's just because I don't look at it doesn't mean it's not useful. I'm sure it's very, very, very useful, but remember, I think Alexandros is more focused. You're focused on more on the lower time frames, right? So you're kind of a bit more sensitive to these things, right, Alexandros? You're looking at the lower time frames. Yeah, exactly. Intraday. Whereas I'm kind of looking at it from a higher time frame perspective. So although it is of course useful for higher for whatever time frame you're looking at in terms of confirmations, for me, I use just slightly different have a slightly different take on the FedWatch tool and what I would rather focus on. So yeah, that's basically the article. So Euro at the moment, not looking good. So I've basically changed my bias to a sell bias. Nothing's looking positive. It's going to be weighed down by the by Donald Trump and his policies. So really, just a sell bias for the foreseeable future. US dollar basically a buy bias, and this is just some of the paragraphs that I kind of copied and pasted from the um, actual Discord group, just as a summary, right? So parity, by the way, on the euro dollar, just to see what that looks like, we're actually at 107.50s. So let's say, for example, we were talking about buying the rumor, selling the fact, right? Buying the rumor, selling the fact. We've got at least something like 600, 700 pips to get down to 700 and yeah, about 750 pips. Uh, Potential, right? This is potentially, right? In this trade, if it does come true, whether or not it comes true, whether it comes down to, 105s, 104s, 103s, right? It doesn't matter, right? The money is made buying the rumor or selling the rumor, shorting the rumor in this case. Yeah. So it doesn't have to materialize for you to make money. But what we do know is that this is backed up by data, right? And it, logical sense. Yeah, just common sense fundamentals. And so now you have a game plan really for the foreseeable future, right? Unless and as long as the data supports that narrative, and that this is really the most important thing, the data has to support the narrative. So the narrative being and the rumor being that, the dollar is going to continue to appreciate based on Donald Trump, obviously being a president, but also him having the House and the Senate, right? Having all three. So if let's say, for example, I don't know, the Senate doesn't come to his, it goes to the Democrats or the House or whatever it is, then maybe it's less likely to get to 10 to get to parity, right? But it doesn't necessarily mean that it won't necessarily still continue to devalue. But let's say an extreme scenario might be, I don't know, there's a conspiracy theory going around that they're going to try and nullify Donald Trump's presidency. I don't know if any of you have seen this, where they're talking about how I think it's like the 14th Amendment, yeah, and the 14th Amendment says something about a person is illegitimate and can't be president if they've taken part in any kind of treason or insurrection against the US government. And then we all know basically what happened, J6. And so there might be a legal challenge coming, right, with for Donald Trump. And so if that does come, by the way, if it's not a conspiracy and it does come and the Democrats challenge and there's uncertainty around that, guess what? Prices are less likely, the euro is less likely to go down to down to parity because it's going to be uncertain that Donald Trump may remain in, as president, right, and get inaugurated. And so there are other things on the horizon, but as long as the data supports the narrative and the rumor, then we should continue moving, to the downside, right? So it's important to keep your finger on the pulse. It's important to keep up to date with what's going on. Don't just take it my word for it and take it for granted. Stay in tune with what's going on. Right. So US dollar, we know that's a buy. And pretty much everything else has, I would say, has it stayed the same? Well, we'll go through it anyway. New Zealand dollar, nothing new.